Hello and welcome to this Forex Preview at xm.com. We'll be taking a look at the upcoming data out of Canada and the potential reaction in the Loonie. I'm Maria Pashverdes, and joining me is investment analyst Cristina Parthenidu. So Cristina, Canada will publish its second quarter GDP data this Wednesday at a time when forecasts provide a large probability for a 75 basis points rate increase in September. What do the forecasts suggest, and how might the data affect the central bank's decision?
Hi Maria, it's nice to see you and wish you a great start to the week. We're starting first with the data. Forecasts are optimistic, waiting for the annualized GDP growth to rise at a faster pace of 4.5% in the second quarter from 3.1% previously. The monthly reading for June is also expected to improve marginally, though, from no growth to just 0.1%. Well, I wouldn't rule out that case. Personally, I think that the second quarter was robust. It was the period when business PMI figures were still quite elevated, near record highs. Exports have been rising exponentially, probably on the back of rising energy prices, and they were rising faster than imports, further strengthening Canada's trade surplus. So since Canada is an oil-dependent economy, that has probably generated significant revenues to Canadian oil producers, given that oil prices have been increasing during the same time. On the demand side now, consumers continue to spend their savings, and the continuous growth in retail sales, as well as the rebounding housing starts and the increasing house prices can justify this. Consumer confidence was also at healthy levels since the unemployment rate remained near record low levels. So overall, I also expect some improvement to be found in the second quarter GDP data, and that will probably provide more incentive for another 75 basis point rate increase in September, because while inflation remains the top priority for the central bank, as long as consumption remains healthy and shows no significant signs of depression, apparently, at some point, the data will start reflecting that high consumer prices and production costs are becoming problematic for consumers and businesses, given the risks from the Ukrainian war and all these climate and pandemic constraints. Higher interest rates will also add pressure at some point, given the high household debt in Canada. But until that is sustainably reflected in the data, the central bank will prioritize its inflation goal and could even keep raising interest rates at an aggressive pace even further. Besides, central banks all over the world have said that they are willing to sacrifice some economic growth to bring inflation to the target. We saw recently the 10-year government bond yield crossing below the 2-year yield in Canada as well, which is commonly considered as a sign that recession is approaching. But with inflation well above the target and the economy showing no convincing signs of contraction, that makes me think that interest rates will not stop rising anytime soon, not before September.
Okay, turning to FX markets now and looking at USD CAD. The Loonie took another beating recently. Could it see a recovery soon?
Indeed, the Loonie seems unable to sustain gains against the US dollar because the Fed is not thinking to slow down its rate hike pace anytime soon. Actually, the Fed is slightly ahead of the Bank of Canada in terms of rate increases, at least for now. And that is providing an advantage to the US dollar. Moreover, oil prices have been trending downwards during the third quarter, so that has added more downside pressure to the Loonie. But compared to other currencies like the euro, the yen, and the British pound, the Loonie is still maintaining an uptrend because of the large monetary divergence with those economies. Now, whether it could have a positive week, given the support from the energy sector for now and the high expectations for a 75 basis point rate increase, which looks imminent after Powell's Jackson Hole speech, I think the Loonie might not pay much attention to the GDP data. We're in the third quarter now, and some indicators have weakened after the second quarter. So the figures may not be a very big market mover for the Loonie this week. Perhaps the U.S. nonfarm payrolls on Friday could cause sharper movements, and more importantly, the OPEC meeting next Monday. That could be another key event to watch after Saudi Arabia suddenly said that it will look for a supply cut at a time when supply is already too tight. Probably Saudi Arabia wants to keep oil prices above the 100 level per barrel. It recently complained about low liquidity in the market, so maybe it wants to see, let's say, more oil producers trading on the paper markets to hedge their production and give a more accurate reflection of market fundamentals, as some analysts also believe. Political reasons might be responsible as well for that. Resumption, let's say, of the Iranian nuclear deal may allow Iran to resume its oil supply, so Saudi Arabia may not like that. On the other hand, it's not a secret that the US president wants lower oil prices ahead of November's midterm elections, and it seems that he's trying to find an alternative way through Iran to lower oil prices, since the Saudis don't seem to be responding to his demands. So a production cut could also be part of a political game for Saudi Arabia to threaten Biden that, I don't want oil prices to further drop from here. And Saudi Arabia can easily justify such a decision by the recession risk. So let's see what happens next Monday. So far, the focus will be on the Canadian GDP and more importantly, 2 years nonfarm payrolls this week. So let's see what happens this Friday.
Christina, thanks so much. And thanks for joining us at XM.com.